stop scrolling and listen to me very carefully. I need you to look at the date on your screen. Today is December 11th, 2025, and if you are watching this video, it means you are witnessing history, or maybe you are witnessing a crime scene. We do not know yet. But here's what we do know. Silver has just shattered every single record in the history of human finance. $61.86 per ounce. Let me repeat that because I do not think you heard me. $61.86. That is not just a new all-time high. That is uncharted territory. That is the kind of number that makes grown men cry because they sold their stack at $30. The previous record was $50 back in 1980, which was 45 years ago. That record is dead. The record from 2011 is dead. But the price is not even the craziest part of this story. Here's where it gets absolutely insane. Right now, as I speak to you, China is airlifting silver across continents. I'm not talking about a few boxes. I'm talking about 660 tons of physical metal loaded onto heavy cargo planes flying desperately from Shanghai to London. Why? Because the vaults in London are running dry. The global financial system is literally running out of the physical metal it needs to settle trades. The Federal Reserve just announced a rate cut today, throwing gasoline on a fire that is already burning down the house. Social media is exploding. Your neighbor who knows nothing about finance is suddenly asking you how to buy silver. The predictions are getting wild. $80, $100. Some people are screaming $200. If you invested $10,000 in silver on January 1st of this year, you would be sitting on $19,000 right now. That's a 100% gain in less than 12 months. You are not just beating the stock market, you are crushing gold, which is only up 56%. You're making Bitcoin look boring. So here's the question that is keeping everyone awake at night. Is this the boy who cried wolf? Is this just another bubble waiting to burst and wipe out your life savings? Or is the wolf finally here? Is this the moment where the paper market breaks and the real price of silver is finally unleashed? Because I need to tell you something. I have seen this movie before. 3 times actually. In 1980, in 2011, and in 2021. And every single time it ended in disaster. It ended in tears. It ended with retail investors holding the bag. Until maybe now. That's what we're going to figure out in the next 20 minutes, because whether you own silver or not, what is happening in the commodity markets right now will affect the value of every dollar in your pocket. This is not financial advice. This is a survival guide for what comes next. By the end of this video, you will know exactly if you should buy, sell, or run for the hills. Let's dive in. Our story begins in the turbulent 1970s. If you think things are bad now, let me tell you about a time when the world was actually falling apart. Enter 3 brothers from Texas, Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt. These were not your average retail traders sitting in their underwear watching YouTube. These were oil tycoons, some of the wealthiest men in America. The economy in the 70s was a dumpster fire. Inflation was raging at 13.5%. There were gas lines around the block. The Iranian Revolution was destabilizing the Middle East. The Soviet Union had just invaded Afghanistan. It felt like the apocalypse. The Hunt brothers looked at the collapsing value of the US dollar and decided that paper money was doomed. They wanted something real. They wanted silver. In 1973, they started buying silver when it was just $3 per ounce. At first, it seemed like a smart hedge against inflation, but greed is a powerful drug. It stopped being an investment and became an obsession. They decided to corner the entire global market. By 1979, the Hunt brothers, along with their Saudi partners, controlled over 100 million ounces of silver. To put that into perspective, they held roughly one-third of the entire global supply of deliverable silver. They had more silver than most governments. The result was the most spectacular price explosion in history. In January 1979, silver was trading at $6 per ounce. By January 1980, just 12 months later, silver hit $50 per ounce. That is a 713% increase in 1 year. The Hunt brothers were sitting on paper profits in the billions. They were the kings of the world. But they made a fatal mistake. They used leverage. They borrowed massive amounts of money to buy even more silver using their existing silver as collateral. They thought they were invincible, but the establishment struck back. And when the establishment strikes back, they do not play fair. First, Tiffany & Company took out a full-page ad in the New York Times condemning the hoarding of silver because they couldn't afford to make jewelry anymore. Then the regulators woke up. The COMEX exchange changed the rules in the middle of the game. They enacted something called Silver Rule 7, which restricted traders to liquidation orders only. Let me explain what that means because it is important. It means you are allowed to sell, but you are strictly forbidden from buying. Imagine playing a game of poker where the casino boss walks over and tells you you can only fold your hand. You cannot bet, you cannot raise, you can only fold. What happens to the price when nobody is allowed to buy? It crashes. The climax came on March 27, 1980, a day that lives in infamy as Silver Thursday. As the price of silver began to slide, the banks issued margin calls to the Hunt brothers. They needed $100 million in cash immediately to cover their loans. They did not have it. They were illiquid. The market imploded. In just 4 days, silver crashed more than 50%, plummeting from $21 to under $11. The Hunt brothers lost $1.7 billion, back when $1 billion actually meant something. By 1988, they were convicted of market manipulation. They were fined $10 million each. They were banned from trading commodities for life, and they filed for one of the largest bankruptcies in Texas history. Silver itself entered a dark age. From its peak of $50, it crashed 90%, eventually bottoming out at $4.90 in 1982. If you bought silver in 1980 hoping to get rich, you lost almost everything. The lesson here is brutal. You cannot fight the regulators, and leverage is a weapon that will blow your hand off if you hold it wrong. But human memory is short. Fast forward 30 years to 2011. The context was different, but the smell of greed was exactly the same. The world was reeling from the 2008 financial crisis. Ben Bernanke and the Federal Reserve were printing trillions of dollars through quantitative easing. The narrative on the street was identical to the 70s. The dollar is going to zero. Hyperinflation is coming. Buy silver or die poor. Driven by this fear, silver went on a tear, rising from $30 to $49.45 in just 4 months. Everyone was screaming that $50 was just a speed bump on the way to $100. Retail investors poured their life savings into SLVs. But there was a problem, a big problem. There was no shortage of silver. The industrial demand was weak. The rally was driven entirely by paper speculation and fear. On May 1, 2011, the trap sprung shut again. The COMEX raised margin requirements 5 times in 9 days. Think about that. They made it 5 times more expensive to hold a position. The price crashed 30% in 5 days, falling to $34. But the torture was just beginning. Over the next 4 years, silver bled out slowly. It fell all the way down to $14, a 71% decline from the peak. If you bought at the top in 2011, you spent the next 13 years underwater. You didn't see your money back until 2024. That's a 13-year prison sentence for a bad trade. And finally, we have 2021, the comedy show, the Reddit squeeze. Fresh off their victory with GameStop, where they squeezed hedge funds out of billions, the Wall Street Bets army turned their eyes to silver. They posted memes. They shouted banks were shorting silver. They tried to engineer a squeeze. On January 28th, silver was $25. By February 1st, it spiked to $30, an 8% surge in one day. The retail crowd cheered. They thought they had won. But on February 8th, it was back to $26. The squeeze lasted less than a week. Why did it fail? Because GameStop was a tiny stock with a $2 billion market cap. The silver market trades over $1.5 trillion a year. Trying to squeeze the silver market with retail money is like trying to drain the ocean with a teaspoon. It was hype without substance. So here's the scorecard of history. 1980 was manipulation and leverage. Result, 90% crash. 2011 was fear and speculation. Result, 70% crash. 2021 was social media delusion. Result, immediate failure. This brings us back to today, December 2025. We are at $61. The charts look parabolic. The hype is deafening. Is this just chapter 4 of the same tragedy, or have the fundamentals of the world finally shifted enough to support these prices? To answer that, we have to stop looking at the charts and start looking at the ground. We need to talk about geology. We need to talk about mines, and we need to talk about the fact that the world is running out of the metal it needs to build the future. Let us look at the pattern one more time, because if you miss this, you miss everything. 1980 lasted 2 years and was driven by manipulation. 2011 lasted 4 months and was driven by speculation. 2021 lasted days and was driven by Reddit hype. And now 2025. We have seen a 12-month rally with a 100% gain. What is the difference? The difference is that every other time it was smoke and mirrors. This time, there is literally no silver left in the vaults. Let me show you exactly what I mean. For the past 5 consecutive years, the global silver market has been in a massive deficit. Demand has exceeded supply every single year since 2020. The numbers are staggering. The projected deficit for 2025 is between 149 and 215 million ounces. That is the largest single-year deficit on record. The 7-year cumulative deficit is over 1.2 billion ounces. Think about that for a second. More than 1 billion ounces of silver have been consumed beyond what was produced. Where did it come from? It came from existing stockpiles. It came from vaults. It came from reserves built up over decades. And those reserves are now running dangerously low. It's like spending your savings account to pay the rent. Eventually, the savings account hits zero and you get evicted. Meanwhile, mine production has declined by 1% year over year. And here's why that matters. Silver is primarily a byproduct of mining copper and zinc and lead. About 70% of silver comes from these operations, not dedicated silver mines. When those base metal prices are low or mines shut down, silver production falls as a side effect. You cannot just turn on silver production like a faucet. Opening new mines takes years of permitting and construction. But here's the most important shift, and this is what makes 2025 completely different from 2011. Industrial demand now accounts for over 60% of silver consumption. In 2011, it was only 50%. This is not jewelry. This is not investment speculation. This is the infrastructure of the 21st century economy, and there is not enough silver to build it. Three forces are devouring silver faster than it can be dug out of the ground. Number one, solar panels. This is the big one. 20% of all global silver, or roughly 200 million ounces, is going into solar energy this year alone. China produces over 90% of the world's solar panels, and they are installing them at an unprecedented rate. They are building enough solar capacity to cover an area the size of Texas. And here's the critical part that most investors do not understand. Once that silver is in a panel, it's effectively gone for 25 to 30 years. It's paste, it's coating. It's not economically viable to recycle silver from old panels at current prices. So this demand is cumulative. It keeps building year after year after year. It's a black hole sucking in silver that never comes back. Number two, electric vehicles. Each electric vehicle uses 2 to 3 times more silver than a gas car. We're talking about 25 to 50 grams in various electrical components per car. Global EV sales are projected to hit 20 million units in 2025. Do the math. That's hundreds of millions of ounces going into vehicles that are driving off the lot. Number three, AI data centers. The artificial intelligence boom is not just happening on your screen, it's happening in physical data centers. Every new AI training cluster, every new 5G tower, every new chip fabrication plant, they all require silver in circuit boards and antennas and server infrastructures. Silver is the most conductive metal on Earth. You cannot build high-speed electronics without it. This industrial demand is not speculative. It's not going away if sentiment shifts. Solar panels need to be built to meet climate goals. EVs need to be manufactured to meet government mandates. 5G networks need to be deployed to support the internet. This is structural, persistent demand that cannot be easily substituted. There is no good replacement for silver in most of these applications that offers the same combination of electrical conductivity and thermal conductivity and cost. This is real. Remember that airlift I mentioned earlier? Let me paint the picture for you so you understand the gravity of this situation. London is the beating heart of the global precious metals trade. It's where the price is set. When London runs low on silver, they don't just make a casual phone call, they panic. The fact that cargo planes were chartered to fly 660 tons of silver from Shanghai to London is the equivalent of a failing bank begging for cash in the middle of the night. It means the delivery mechanism was days away from breaking. It means that for a brief moment, the paper contracts that govern the global price of silver were worthless because there was no metal to back them up. I've covered commodity markets for years. I've never seen anything like this. When the world's largest financial centers are airlifting metal across continents in an emergency, that's not a bull market. That's a supply chain heart attack. And the charts confirm the panic. The silver market has been in severe backwardation. Now, I know that sounds like technical jargon that only nerds care about, so let me explain it simply. In a normal, healthy market, silver to be delivered next year should cost more than silver right now. Why? Because of storage costs and insurance and interest rates. It costs money to hold metal. But right now, the situation is flipped upside down. People are paying a massive premium to get their hands on silver today. They don't care about next year. They need it now. This means traders believe cash is trash, and having the metal in hand is the only thing that matters. That's acute scarcity. That's the market screaming that it doesn't trust the future. On November 28, reports surfaced of massive system strains at the CME during silver delivery notices. The rumors were flying that a major entity couldn't deliver the metal they promised. The very next day, the market gapped up 5.53%. Why? Because the big boys realized the vault doors were open, but the room was empty. Look at the Shanghai Gold Exchange. Their vault inventories have plummeted to their lowest level since 2015. They're draining 29 tons of silver per week. At this rate, Shanghai will be empty before the next iPhone comes out. And here's the final nail in the coffin for cheap silver. In 2023 and 2024, several governments, including the United States, officially designated silver as a critical mineral. That's the same category as lithium and cobalt and uranium. Do you understand what that means? When governments start treating a boring metal as a matter of national security, the game has fundamentally changed. It means they're worried. It means they know what I'm telling you, that there isn't enough silver to power the green energy revolution and the military-industrial complex at the same time. In 1980, it was a game of sharks hunting for paper profits. In 2025, it's a war for survival. Samsung and Tesla and Apple don't buy silver to speculate. They don't buy silver to get rich. They buy it because without it, their factories stop running. They're not looking for a return on investment. They're looking for raw materials to stay in business. And that's a buyer who will pay any price. If you are a procurement manager at a solar company and you need silver, you don't care if the chart looks overbought. You buy it, because if you don't, your company dies. This is the difference between a speculative bubble and a supply crunch. Speculators sell when they make a profit. Industrial users buy until the metal runs out. The smart money knows this. That's why they're not selling. In previous cycles, as soon as the price spiked, the whales would dump their holdings on the retail investors. This time, the whales are holding. They are buying. Because once you sell your physical silver, you might never get it back. Now, before you go out and sell your kidney to buy silver bullion, let me drag you back down to earth. Because even when the fundamentals are screaming buy, the market has a nasty habit of destroying latecomers. The wolf is real, but he can still bite your hand off if you try to feed him. Silver is up 100% in 12 months. That is a vertical line on the chart. If you think it is going to go up in a straight line forever, you are delusional. A 20% correction from here would take us back to $48. That's a bear market for most assets, but just a Tuesday for silver. Here are the 3 ways you can still lose everything, even if you are right about the big picture. Trap number 1, the recession. This is the elephant in the room. Remember what I told you. 60% of silver demand is now industrial. If the global economy crashes, nobody buys electric cars, nobody builds new solar farms, nobody upgrades to the newest iPhone. In a deep recession, demand destruction happens faster than supply constraints. We have seen this before. In 2008, silver crashed from $20 to $9 in a matter of months, despite a massive bull run in gold. Why? Because investors treated gold as money, but they treated silver as an industrial commodity. If the factories stop running, the price stops rising. If we hit a hard landing recession next year, that silver deficit could vanish overnight. Trap number 2. The referee changes the rules. I cannot stress this enough. Both 1980 and 2011 ended because the exchanges changed the margin requirements. They changed the rules to protect the banks. If the bullion banks who are short silver start losing too much money, the regulators will step in. They will hike margin requirements. They will ban new buy orders. They will do whatever it takes to save the system. Do not fight the Fed and do not fight the House. The casino always wins eventually. Also remember that high prices are the cure for high prices. At $60 per ounce, every mine in the world becomes profitable. This will incentivize mining companies to dig faster. It takes time, usually 2 to 5 years, but eventually supply will flood the market and crush the price. Trap number 3, your own psychology. This is the biggest risk of all. A 20% drop usually flushes out the tourists. Are you prepared to watch your account value drop by thousands of dollars in a single week? Many investors who bought at $30 are sitting on huge profits. The temptation to sell is massive. If we see a rush for the exits, it could trigger a cascade of stop losses. The price falls, you panic, you sell at the bottom, and then the price rips back up without you. That is the oldest story in the book. And here's another risk. While the Fed cut rates today, they also signaled caution about future cuts. If inflation proves stickier than expected and the Fed has to hold rates higher for longer, that strengthens the dollar. A strong dollar is kryptonite for precious metals. So what should you do? Here's the playbook for the sane investor who wants to make money, not just noise. First, watch the Shanghai inventory levels. This is your dashboard. If they keep dropping, the bull run is alive. If they start rebuilding, get out. Second, watch the solar panel production data from China. That is your leading indicator for industrial demand. Third, and most importantly, stop using leverage. I repeat, stop using leverage. The Hunt brothers had billions of dollars, and leverage still killed them. You are not smarter than the Hunt brothers. If you buy physical silver or unleveraged ETFs, you can ride out a 50% drop. If you use leverage, a 10% drop wipes you out. For long-term holders, if you believe the supply deficit thesis, volatility is just noise. Consider dollar-cost averaging. Buy a little bit every month regardless of the price. For traders, keep your stop losses tight and take profits on the rips. Do not fall in love with your position. And for those on the sidelines waiting for a pullback to $48 or $52 might be the smartest play you can make. Do not chase the green candles. Let the price come to you. Let us return to where we started. Is this the boy who cried wolf, or is the wolf finally here? Based on everything we have examined, the answer is terrifyingly simple. This time, the wolf is real. The 2025 silver rally is driven by something the previous 3 were not. It's driven by a genuine multi-year structural supply deficit meeting unprecedented industrial demand. 1980 was an artificial shortage created by manipulation. It was unsustainable. 2011 was speculation without a supply shortage. It was unsustainable. 2021 was social media hype without fundamentals. It was unsustainable. But 2025 is a mathematical reality. You can't manufacture 200 million ounces of silver for solar panels if the silver doesn't exist. The laws of physics don't care about market sentiment, they don't care about the charts, and they certainly don't care about your feelings. However, I will leave you with one of the most important investment quotes of all time from the economist John Maynard Keynes. Markets can stay irrational longer than you can stay solvent. The wolf is real, but that doesn't mean you won't get bitten if you try to pet him. You can be right about the fundamentals and still lose everything on the journey if your timing is wrong or you're over-leveraged. The question is not whether the supply crisis is real. It is. The question is whether you have the stomach to handle the volatility on the way up, because if history teaches us anything, it's this. You can be right about where we're going and still die on the journey. The wolf is here. Just don't let him eat you.